Last month, I did a video on CVS to try to determine if CVS was a good buying opportunity or not. And looking back at my analysis, my upside potential was around 61%, as you could see in this graph. But I personally like to double my money every 3 to 5 years whenever I'm buying a specific stock. I don't look over the next 10 years because in 10 years from now, there could be a lot of changes and no one can predict 10 years from now. But I believe over the next 3 to 5 years, it's pretty hard for us to overpay, which is why I look at a more shorter term, type of frame. And then whenever I can get my double on a specific stock, like maybe CVS or another one, then after I get my double, I can decide, should I hold another 5-10 years or should I take my profits? But I always try to get some profits, in my pocket first before I think over the next, 10 to 20 years. And for me to double my money on CVS, my analysis says that I have to buy it pretty close to $72 per share. Well, now CVS went from $91 per share from my last video to $81 per share and is falling down every single day, pretty much like some type of a meme coin, like a falling knife. Every single day the stock is down. I can barely look and see, CVS being up or anything. And in this video, I'm going to discuss those reasons why CVS is just going down every single day. Technically, why is it down 26% from its 52-week highs, and it seems to be going to $76 per share, based on some basic technicals. So I'm going to review my analysis again, my valuation model, and try to determine a good price on CVS and just determine why it's going down in general, and if this uncertainty is justified or not. So I hope you enjoy this video. Now, one of the main reasons why CVS is going down every single day is because of some huge acquisitions they made. The first one was Oak Street Health for $10.6 billion. And Oak Street Health will actually provide them access to primary, medical cares and some, 169 medical centers. They said they can take it up to 600 medical centers, I believe, by 2025 or 2026. So it's pretty amazing for CVS to be able to get exposure to the primary care, and services and stuff like that. So when I say, why is the stock going down? Well, yes, because they paid $10.6 billion for a money-losing company. And this is what it says. It says the clinic operator is expected to lose over $200 million in 2023 and not reach profitability until 2025 at the earliest. So CVS, again, paid $10.6 billion for a money-losing company. And this is not the first one that they actually did. They had another one, which I believe also is a money-losing company, and this is Signify Health, and they paid, I believe, around $8.6 billion, and Signify Health is more on how in-house and home care, type of provider. And all those three will put CVS in a very dominant position in the healthcare space, and it will be vertically integrated, and it will be, again, pretty amazing for CVS. But both of those companies, I believe, are money-losing companies, and the market is scared that maybe CVS is actually overpaying and is taking on over $20 billion of additional debt. Now, they have around $13 billion of cash, but again, that would be around maybe $8 to $7 billion of extra debt, while CVS by itself is now paying around $2 billion every single year in interest expense on $49 billion of debt. So this creates a lot of uncertainty, and I believe what markets wanted and what investors wanted, they wanted CVS to pay down the debt first, save on interest expense, it's over $2.2 billion on their debt, and then maybe after do those acquisitions and do those kind of things and not overpay for them. This is why I believe the market is going down. But I have seen this before, actually. I was watching it with my own eyes, and it was the same story where CVS was trying to acquire a company. Maybe they overpaid for it, and the company, Aetna, is actually in an industry where CVS has no exposure to, so maybe CVS is gonna mismanage it and all kind of things, and the stock sold off. And I wanted to actually buy it when it did sell off, and I actually didn't pull the trigger, and I've been watching it, go up, pretty much since then. From me personally, looking at those acquisitions, which I believe both of them are unprofitable, maybe CVS might have overpaid, and the stock has to go down. I believe it's actually justified for the uncertainty to be happening. And again, I would be very worried if I haven't seen the amazing execution that the management actually did since they acquired Aetna. They had over $71 billion of debt, and now their debt is approaching $49 billion. The free cash flow more than doubled from 2018 2018, around 6.8 billion. It was up to 15.7 billion in 2021, and now it's around 13.5 billion in 2022. So this is more than double the free cash flow since they actually did the acquisition. And again, the stock is pretty far from a double at such, prices from the bottom in 2018. So I've seen the massive executions, the amazing executions that the management actually did in acquiring those companies and then deleveraging with the free cash flow. So it'd be hard for me to really bet against such managements that did such, track record, but they could be making a mistake, and we're going to eventually find out if they are making a mistake. But I did cover in my previous videos that the CVS's debt is actually locked in for like 30, 40 years, and the interest expense is actually very low on this debt in terms of the percentage of the, interest rate. But I would actually preferred if they paid down the debt before putting out the growth first. And to keep their commitment, the management actually gave a 3-year guidance. I mean, even tech companies or waste management, which have a predictable business model, they don't give 3 years guidance. But CVS management is actually very confident about everything they are doing, and they're likely going to do whatever it takes to achieve those numbers. And this is something you have to respect from what the management, actually did. And they have between 870 to 890 for 2023, $9 of EPS for 2024, and $10 of EPS in 2025, plus some other, type of litigation and mitigations and stuff that they are actually, working on. And looking at the forward PE ratio of CVS, now is trading around 9 times earnings. And 9 times earnings has been historically on the lower end of the range for CVS. It traded at a mean of around 12.9, pretty close to 13 in terms of the mean, and it traded as low as 7.5 times earnings in March 2020. All right. Now, looking at this whole thing and looking at their, acquisition, and looking at the main reason why the stock is going down, which is because of the acquisitions. Now, if CVS can actually prove again from now till 2025 that those acquisitions were good acquisitions, that they actually haven't overpaid for those acquisitions, just doing again basic math, maybe they can get back to where they were trading at of around, pretty close to 12 times earnings, just as a mean. And I would argue maybe CVS could trade even higher if those acquisitions actually provided the growth that CVS talked about on their earnings call. But again, taking their 10 EPS and we time it by 12 times earnings, which if they could get back to it, this is $120 per share. If we take that and then we divide it by $81 per share, this is around 48% on the upside over the next 2 years, not actually, factoring in the dividend that CVS is going to pay you around the 3% in 2023, 2024, 2025. So it's around 3 years. So 3 years, around 48% return. This is not bad at all. Now, what if it trades again at 10 times earnings, not at 12 times earnings, and those, acquisitions were a disaster, then it's around a 20% on the upside, not including the dividend over the next 2 to 3 years. So in my personal opinion, it's really hard to lose, money on CVS if they actually can make those numbers of $10 of EPS or $9 of EPS. Looks like they're going to use a combination of buybacks, 2 to 3% every single year, and then some cost improvements and some growth within the business to actually achieve that stuff. And I personally saw the execution of the management, and I'm actually pretty confident that they will do whatever it takes to actually achieve those numbers. So looking at those numbers, actually CVS, again, it does look undervalued. But if I go back to my video and I use my basic, calculation of, 7% and then 4%, revenue growth with a PE ratio of 12, again, I'm not getting my double on CVS, including the dividend and the, buyback. And I would prefer to buy CVS given the risks of those acquisitions not working with some margin of safety. And I believe $72 is still a very good price. Now, looking at the technicals, it might actually find some support around the $76 per share. So I might take my chances around the $76 per share because I actually like CVS for the long term as a, long-term investment. But again, I might decide, not to buy it. So don't just, wait for me and wait for my price for you to buy CVS. If you're a very long-term investor, I mean, it's not really bad to, open a small position and dollar cost average down. But to me, it looks like CVS is likely, going to continue going down and maybe, stop at 76 and maybe go even lower. But as closer we get to my price of $72 per share, I will get more and more interested in actually owning CVS. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.